How do investors find value on the JSE when price-to-earning ratios are near all-time highs? Anthea Gardner, the Managing Director at Cartesian Capital, joins us at the desk for her views. Anthea, thank you for making the time to join us, but maybe let's take a step back. Cartesian Capital, relatively new in the asset management jungle, if I may call it that. Just remind us, what is your investment philosophy?
Good evening, Nazipo. Thank you for having me. Yes, very new actually. We only just got our license in July. We started the business in January. Difficult times to be starting a new asset management business in the jungle, as you call it. But we have a core satellite approach to investing, and so we look at how to maximize your returns across the board. So how do you diversify? Where do you find value? What are you looking for? What are your long-term investment horizons?
Anthea, Lindsay in Cape Town. I keep on hearing different views from different people. That some people say to me, maybe the JSE is close to being fully priced, but it's certainly not overvalued. It's certainly not undervalued either. So it's sort of Goldilocks at the moment. And other people say, quite rightly, that I think 6 or 7 stocks account for 65–70% of the market capitalization of the JSE, and take out Naspers and a couple of the other high flyers, and it brings down our PE ratio. So it's very confusing for simple broadcasters like myself.
You're absolutely right, Lindsay. Let's take a step back for just a minute. The all-share total return in the last 5 years is 134%. On the SWIX total return, it's 143%. We're looking at PEs of 18.7, which is about 3% off the 20-year high. And if you look at it like that, then definitely the market feels heavy. Include the fact that there's a disconnect between the market and our economy. And so we're talking about GDP growth that is under pressure, down, keeps getting revised down, and currently I think sitting at 1.5%. We've had the African bank failure. People are worried, you know, where do we go from here? Is the market overpriced? I'm inclined to say we are probably due a correction. I'm not sure when it's going to come. My feeling is that you can't blanket invest at this stage. What you're really looking for are the shares or the companies that offer good value, still are offering good returns, companies that are well run. So it really is a stock picker's market, I would say.
Can you give us 5 of those?
I can certainly give you a few, yes.
Genuinely, and I mean, why you'd go for that? You know, if you're saying that there are still pockets of value, it's you know, where do you find them, and how secure are those?
Well, how secure are they? And this is probably a contrarian view.
No, against your background, you know, you say you're looking for good companies, well managed and so on.
Absolutely. So let's start with kind of the banking sector. So most people are worried about the banking sector because of what happened with African Bank. But I think the flip side of that is that the SARB reacted really well, and our banks are generally well regarded internationally, even though the ratings agency recently downgraded South Africa Inc. and downgraded our banks. I quite like Standard Bank, and the reason I like them is because they've spent lots of money on kind of building the business, bringing it up to speed from an IT perspective, and then particularly their Africa expansion story. So I would say my first pick, Standard Bank. There are other companies in the JSE like Grand Parade, for example. There's a fairly significant, specific company, good management. They're sitting on lots of cash. They're bringing a business to South Africa, which is new, which is interesting. So yes, I would be long Grand Parade as well, and hopefully they'll get the lottery.
Anthea, sorry, here I am calling you Anthony. How do we make sense of how do we make sense of the divergence that we're seeing when it comes to the performance that we're seeing on the stock exchange and the performance of the economy? We just had Jill Marcus saying that we're revising that GDP forecast down to 1.5%. They seem to be pointing in opposite direction more and more each day.
That is certainly a good question, but if you look at where the capital has to flow, so when we're talking generally, I suspect we're talking about the equity market and we're talking about stocks. But what are our other options? So the fixed income market, for example, the R157, let's use that as a benchmark, which is the government bond that matures in a year's time. That is yielding not even 7% at the moment. Compare that to the equity market. So the all share this year, the total return I think is on 20% already. You know, we're in this discussion of kind of capital preservation or opportunity cost, I think, is where this discussion is heading to. So do we preserve capital in the fixed income markets and take our 7 or our 8% or 8.2, whatever the R186 is at the moment, or do we try and go for the riskier assets and miss out on things like Tongaat, which I think is up 38%. You correct me if I'm wrong here. It's up 38% year to date relative to the fixed income market where you're getting 7%. So this divergence of economy and equity market is because I think there's no other place to be, really.
Anthea, Lindsay again in Cape Town. What worried me today about the market, and David is a worrier when it comes to market action as well, every single sector was down. There wasn't one that was spared. I mean, it was between, let's call it between 1.5% down and 3.5%, and that was the outsider of the field, and that was platinum stocks. I suppose that if there's nowhere to hide in the future, because there's going to be a 10, 15, 20% correction led by the States perhaps, or led by China perhaps, then maybe it's just the defensive stocks with relatively low PEs that ply their trade overseas, like, I don't know, Mediclinic, Life Healthcare, people like that.
Lindsay, I think you've hit the nail on the head. That's exactly right. Where we probably should be looking, if we're going to look for the defensives, is in the rand hedges. Even a stock like Steiner, for example, which has great opportunities offshore in Europe, and even though Europe probably is not going to shoot the lights out, I think Steinhoff is quite specific in that it has a specific target in Europe where it's has potential to buy out the smaller companies and to make its name. So yes, rand hedge stocks, I guess, is where you would be.
So Anthea, how do you differentiate yourself from other asset managers who are doing very similar things in a very tight market? In a market like South Africa where you've got a handful of shares that you can buy, first of all, what does Cartesian mean? And then how do you differentiate? You know, what's your big selling point?
Lots of questions there, David. Okay, let's start with what does Cartesian mean. So the name Cartesian is derived from the French mathematician and philosopher René Descartes, who said, "I think, therefore I am." He's also the mathematician who designed the Cartesian plane, which is where you get your XY axis, and the intercept is 0. And from it comes your GPS coordinates. So your Cartesian coordinates are the coordinates you put into your GPS. How do we define ourselves? I think at this stage we're still small enough to be very careful to do proper risk-reward analysis for our clients, and we don't blanket invest. It's about what our clients need, where they are in their time horizon on their investment scale. And because we believe in this approach where you could either follow the market, which makes you a benchmark follower, which would be really the core of your investment, or you could have a satellite, or you could combine the two, and the satellite really would be where you're looking for extraordinary yields or returns on shares that are not specifically linked to the market.
Just to get your views on PPC, since I'm told in my ear that you've had passionate views about this particular stock in the past. So we saw them slumping by almost 8% today. What would you be advising on this one?
Yes, I'm afraid I had to sell out today. I mean, I honestly believe that part of a good company is good management. It's important that the companies we're looking at in this tough environment, the management understand how to negotiate or how to navigate these tough economic times. And when you're faced with a company where the CEO resigns at a whim, I think it's worrying. I still think I like PPC, I do. I like their Africa expansion story, but I'm waiting to see what happens. I want the share to settle down before I decide whether or not to get back into it.
Quick one, Anthea. The head of an interview that I've got here, a transcript of an interview you did with a chap called Rake van der Kerk. You say, I think we're in for a correction, but try to time the market and you're in for a hiding. Well, the market got a hiding today, so maybe we started. So just wrap up your philosophy, if you would, last 30 seconds.
Yes, I think things are looking a bit shaky, and that's probably why I'm sitting here today. So this is exactly where we need to start deciding whether or not we're going to be more into fixed income and whether we're going to be happy to take the 7% that we're getting in fixed income markets, and how perhaps we're going to find outperformance in the Mediclinics, the Steinhoffs, the Grand Parades. So yes, I would be very careful. I wouldn't want to be in an index right now. I would be stock picking.
Anthea, thank you so much for joining